Hey guys, this is Terry with Futures.io, and it's my pleasure to welcome Alex Haywood for today's webinar, Diving into Order Flow, sponsored by Jigsaw Trading. Now, during the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. Also, if you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. Don't forget that you can now follow us on Facebook, YouTube, and Twitter with @Futures.io. And without further delay, I'll hand it over to Alex.
Great, thanks Terry, and thank you for having me, for both yourself and Jigsaw. This is obviously my very first, also my virgin experience doing a webinar. So I'm a rather internet hermit, but exciting to be doing this, and especially on a subject within the intraday trading community, being the order flow, and really the slides that I'll be going through today are all geared around, a collective experience over many years of, being with traders, being within the proprietary trading industry, and more importantly, when you're exposed within a trading floor, which I have been, my entire professional career, is that collective experience, that collective learning, and making sure you open up your ears, your visual elements. And really, these slides are a functional product and a few elements that we'll be touching on today, and we're just going to be really sweeping the surface.
You should have the pop-up, to share your screen.
Oh, so you can't share my screen. Okay, just hold on a sec. Can you see that now?
Yes, there we go. Perfect. Thank you.
Okay, fantastic. And with regards to what we'll be looking at is really, for me, one of the foundational elements, of my personal career of looking at the price ladder, and also what we train all our young traders on our various trading floors, and it's really quite a paramount element in our training, and it's fantastic just to be on here and share just a snippet of some of the elements that we look at on our various training programs. And again, just if I had to have a metaphor, this, or a symbol, if you look at this first slide, you can see this speedometer, and really the whole presentation is built on the auction exchange and the market velocity, and really from that basis of how to determine when a market is shifting gears, and therefore how to deploy at the correct and the most you deploy the most appropriate trading strategy, where you, as always for any trader, minimizing your risk, and the grain old saying, minimizing your risk and exposing yourself towards the upside. So just bear with me during this seminar. I do have a habit of veering off a track, so that's why I prefer to have the questions right at the end, because I can veer off track rather easily. So I will get into the zone and get into the focus, and hopefully for any of you who have heard me before on any of our internal streams, or any of our younger traders, I do try and paint a message with a few symbols. So let's go ahead. Okay, so let's just really start off what is market velocity. Now, it's really the pace of the tape, from a price ladder experience. Now, I don't know, I'm assuming in this webinar that people have potentially traded on the price ladder, or have traded actively or on the simulator. So I'm assuming a certain level of understanding. For those of you who never have traded on the price ladder, then I apologize, and I hope I just do spark a certain interest for you to potentially go and investigate further, and then after that, potentially you can revisit this slide, and it might make a little bit more sense for all of you out there. So, market velocity. Market velocity is the speed of the orders going through the market. Now, I hope you guys can all read, so I'm going to try and draw on my slide over here. But essentially, how you set up a price ladder. So this over here is the price, and these are the offer orders, and these are the bids, okay? And then the market price is this, I assume, would be the S&P 500 is 2169 and 3/4. If you want to buy at market, and if you wanted to sell at market, 2169 and a half. Now, what I'm concerned with, and we don't have the volume profile over here, but I'll be showing you that in a little moment. What I'm concerned with is this column over here. Okay, and that's the actual orders that are going through the market, and more importantly, the speed and the nature of the orders going through the market, and therefore how the market price, whether it's on the bid or on the offer, how they are absorbing it, how they're taking it, and how they're auctioning it. And this is really the crux of this entire presentation, is what's going through the market, at what speed is it going through the market, and how that determines the environmental conditions. So by understanding the different market velocity environments in conjunction with passive order movement is the foundation to developing an arsenal of price ladder patterns. And really, whether you're trading the market at an extreme of the day, at the low, or a high of the market is trading mid-range, is really going to determine on how fast the orders are going through the market, of what type of strategy that you want to be participating in. You know, there are type of strategies where you're trading within algorithms and the market's a lot more lethargic, and we'll define lethargic in a little moment, or where the market is moving at exceptional pace. And you could describe pace as, 100 lots per second in a particular type of market. For example, if it's 2,000 lots per second in the S&P 500, potentially that's medium to high velocity. If it's 20 lots per second in the S&P 500 or the Euro USD, then potentially it is not as high intensity and there's not much intent in the market. So this is how we describe market velocity, is the speed of the orders going through the market. And what we're looking at is the market velocity is not concerned with the size of the bids and the offers, but rather what is being traded and how the price is being traded. So again, a lot of people, when they bring up the ladder for the first time, and it certainly happened with me in the early parts of my career, and potentially as long as the first year and a half, 18 months of my career, is all I was concerned with was how large these orders were or how small these orders were, and especially when they were at market price. So when you actually see the orders, that is all I used to be concerned with. But that doesn't tell you anything, because there's so many types of hedge strategies going around in the market. There's so many potential orders that aren't real, that get pulled again. And so what's really important for me is not this, but how potentially the market price reacts to the orders going through. So the at-market bid or the at-market offer, and when those prices are being traded, how is it digesting the actual real traded volume in the market, and how quickly is the real traded volume going through the market. So again, a lot of young people do seem to be fixated, because I know at least I was, and we try and ensure with our younger traders that they keep a very close observation of the orders that go through the market. And if I had to show you, so let me just clear up my page over here. So just before I do that, I wanted to show you something on the jigsaw ladder in a moment. But if you see this, so it's about the speed of the exchange versus buyers and sellers. So the speed of exchange. So how are buyers and sellers interacting there? Not how the order size is changing, but the speed of the exchange. So when the market is bid for 605 lots at 2169.5, and 600 lots goes through there, does it reload itself? How quickly does it reload? How often is it happening? And that's what I'm really concerned with, is the speed of the exchange versus the buyers and sellers. Then the level of auctioning activity and the progress of the auction. Now this is really important for what some of you who trade certain type of momentum breakout trades, when you're looking at a certain technical level. So if you have a level to the upside and the market has been hitting it multiple times, then all of a sudden it breaches. Now from a price ladder perspective, what's really critical and important is for this market continue handsomely towards the upside. What you really want to see is the level of auction activity and the progress of the auction. You really want to see high level of auctioning. And what that means is that every price that it trades, in this instance up, that you're auctioning the price, quite concretely. And what I mean by that is if the market just worked because there were stops being triggered and it triggered a few stops and all of a sudden the order activity died down and it slowly leaked back, then invariably that market could actually potentially roll over. But on the price ladder, if you're actually seeing that the integrity of the auction and that, and you have to know each of your markets, you have to know your specific market's personality, and every market has its own speed personality and its own velocity personality and its own auctioning personality. And in this instance, an auctioning activity is, for example, every price trades 3,000, say 6,000 lots before it bids over. So there's the handsome exchange between each price, and therefore when it auctions each price, concretely, then the market can continue without coming to revisit that price. And as long as it's auctioning every price, really well, then what happens a lot of, younger traders is when the market breaks above level and they don't see a very fast move, then they think the market has potentially lost impetus. But sometimes the market breaks very quickly. It's quite easy to trade back if these prices weren't auctioned well. So that's why sometimes you can have a fairly deep retracement after an initial break. Whereas if the market just grinds but a high speed, high auctioning, and it's actually auctioning every price, so the buyers and sellers are engaging at a higher than average exchange rate between each other, then the market can really, it's protecting itself higher and higher as it's putting its flag higher and higher into new price territory, and therefore it can continue and continue higher. So that's what I mean by the level of auction activity, and every market has its own level of auctioning activity. So really important. So for example, I trade the Bund, which is a German 10-year bond most often, and I know the market breaches new territory, and it's and there's really nice pickup in volume, and every price is being auctioned. I want to see between 2,000 to 3,000 lots, for every price until it finds a new value zone. So for example, the market moves up, it's auctioning 2,000 to 3,000 lots. Then there's what's called an area of interest, a high exchange area. So there's a lot of volume activity going on, and then from that basis, the market has built another base to launch itself to the upside. But as long as it's auctioned every price, then there's a greater probability in your trade plan for, in this instance, a breakout trade, for the market to continue towards the upside. Okay, and then the next point with regards to market velocity is the relative auctioning speed of the day. Now, this is really one of my favorites. If I show you what I mean, and let me actually just pull a ladder for you here. So let me get a jigsaw ladder over here. What I've got here is the Bund, and this is actually the Bund. Today we're using the replay technology, which is such a great learning tool to go practice your, anything interesting you noticed on the price ladder in the day, any patterns, any order flow patterns, any scalping techniques, or anything that you potentially lost money in. It's really great to go back, look on the replay functionality, and Jigsaw supported by a wonderful replay technology that we actually use in-house in our London trading floor, and we'll be branching that out in a few of our other floors. But if you look over here, this is actually today during the ECB event after the 12:45, and this is at 1:05 British Standard Time. And the relative auction speed, and what I'm talking about over here. Now, if you see here, okay, so hopefully you guys can focus. Let me try and make this a little bit bigger so you can have a look. Okay, so the market is trading bid 164.62. Now, the most currently traded price at this price is 102 lots has just been gone through at 62. The current traded lots that have gone through 60, 102 lots. Now, another one lot went down at 61, as you can see over here. And we're watching now this pace at this current moment. The market at this area, it's on the low bounds of the so-called value area, volume value area. So again, I'm assuming some people perhaps understand what a volume, a value area is. At the lower extremes, the pace of the market at the moment is fairly slow and lethargic. So the auctioning speed is, there's 266 lots, so that's a little bit more intense over here at 164.62. And when I talk about the relative auctioning speed is, if the market is trading at the low bounds of this range at around 20, 25 lots every 2 seconds, or say 500 lots every 5 seconds, but then it starts trading towards the upper bounds of this range or this value area, if all of a sudden the auctioning speed is picking up a lot higher relative to it was at this range, and this is your classic market profile theory, or your classic auctioning theory, is if I tell everyone, if I want to sell everyone in this webinar a brand new iPad 20 for $2, who's going to put their hands up? And everyone's going to put their hands up. And when I say $5, everyone will put their hands up. If I say $10, until I get to a price where all of a sudden the auctioning speed and the velocity of hands going up in the air really starts slowing down. If I start going to $300, I'm going to have less people putting up their hands. If I start going to $600, I'm going to start having even less people putting up their hands. And it's the same concept of the market. The market ebbs and flows in a direction until it doesn't find any more participants who are interested in that price area. So that's why the relative auctioning speed of a price to price zone is so important. As you watch the market on its day, so it's relative auction on its day, or on the week if you have really good price memory of these ranges, and you can see here the market is really quite slow and lethargic. It's only slow and lethargic relatively to what it will be potentially later on. And that's why what I'm going to show you a little bit later when we look at the ECB example, where the market starts trading at 164.70, 73 in today's European Central Bank event, and all of a sudden the rate of knots of orders going through the market really start increasing. And when you start observing that and you're seeing the buyers start holding the bid, then all of a sudden you can have greater conviction to enter in at a trade, find that buying opportunity, and potentially being protected by the velocity of of a lot of participants are now agreeing in this new area. And when participants are agreeing in this new area, therefore the market will continue auctioning until it stops finding participants that are interested in the higher zone or the higher area. And so if you understand relative auctioning speed or the price zone, if down here when the market starts escaping towards the upside and it starts increasing, you'll say, oh, well, I do recall that when the market was trading down here, it was doing it about, say, for example, 100 lots per second. When I talk about 100 lots per second, I'm just picking random numbers at the moment. A lot of the time is as you observe and watch the ladder consistently, your eyes are amazing. Your eyes and your cognitive skills start picking up relative speed of the market, through screen time, like riding a bike, like practicing your forehand in tennis, like practicing your swing in baseball, that repetitive action, but a conscious repetitive action. You really start to pick up these subtle nuances of what high speed is for your market and what low speed is. So all of a sudden, when the market starts auctioning back up towards the upside and the speed really does pick up rather aggressively, then all of a sudden you're saying, well, compared to the upper bound of this range, compared to here, the auctioning and the exchange and the auctioning speed relatively to this area was a lot higher, so therefore on the balance of probabilities, the market has a greater chance to start maneuvering towards the upside. So I hope I haven't lost too many people. I mean, that's a little bit, of a mid-level to an advanced, analysis of market velocity. But just watch what I was talking about again, and more importantly, go back and pull up a ladder. And one day, just pick your range area. And this is a nice little practice that we use with our younger traders, is pick, watch the market in a range. Later on, see where the market breaches outside the range. As the range, is in its compressed state, and then it moves and evolves into its expansionary state as it shifts out of its most recent value. And look what the auction, go replay back your ladder. Look at what the auctioning speed looked like. Say if the market breached towards the downside, look at what the auctioning speed looked on the upper bounds of the range, and then look at when it breached towards the downside and what that auctioning speed looked like. And the market always gives you a clue before it starts moving in a direction from a compressed state to an expansive state. And And it's just whether you have that, that focused attention, especially as an intraday trader. It's rather critical to have that ability to understand. So I hope all of you have been watching the pace of this area over here. And we're now sitting at about, 10 minutes past 1 British Standard Time. This is again a replay from earlier today. And you'll notice that above the 73s, the market, all I was thinking of today is noticing this really slow auction activity is once the market approaches the 73s. If I saw, and remember it's a condition, if I saw the relative speed start picking up substantially more than it was down here, then the probability of a break is a lot higher, and I'll start going with a momentum move towards the upside. Okay, so that is really, the first, slide on, what is market velocity, and it's the speed of the exchange between the buyers and sellers and what is actually being traded, as opposed to just looking at the size of the bid or the offer. Okay, and what's really rather important, and again, let's just define what is market velocity. It's the energy and the health of the market is measured by, so the energy and the health of the market is measured by the level of activity. Now, when the VIX level is really low, or the any volatility measure in the market is extremely low, well then what happens is you don't have many participants in the market. And when you don't have many participants in the market, it's very hard to see where the buyers and sellers are located, or if it's a very quiet day, if it's the Monday after non-farm payrolls, or if it's one of those weeks that's sandwiched between a big central bank event and a couple of key data points, well then sometimes it's very difficult to see the underlying action in the market. And that's why, for us on our trading floor, what's really important is we always know, regardless of as long as the data point, and what we always say, as long as the data point or the macro event causes volume and volatility, as long as it creates volume and volatility, it doesn't matter if the data point, is a big beat or a big miss, and it doesn't mean the market should move in the direction of that of the beat or the miss of the data point. What's important is when the market gets tested with the news data point, all of a sudden you can start seeing the activity in the market, and we just want to be able to see, well, where are the buyers and sellers located, what do they look like at the extremes of the daily range, and so forth. And I use the higher the level of the activity and market participation, the easier to deduce market engagement and the battle between buyers and sellers. And if I use a little metaphor, it's like a stagnant pond that gets brought back to life when a stone is tossed into it. You can start seeing the sea life as activity is awakened. And I associate that little stone being a data point or macro event, like the ECB central bank, the ECB central bank event today is the moment a little stone is dropped into the water and it starts rippling, you can start seeing the sea life below, or you can start seeing the buyers and the seller below. You just need that trigger to awaken the market, to see where all the positions are caught. And that's why you have the power of the price ladder, because before a chart reaches its extremes, a lot of technical analysis, a lot of charting landscape is always, being defined by lines. And just remember, the price ladder is the rawest form of the market. Everything, every line, every chart, every oscillator is deduced from this raw price action that's going on. And sometimes you're seeing activity mid-range approaching towards the area, and that was the case today, when the market breached the 73s with, good auctioning activity, good speed, good velocity. All of a sudden the market's not in the range. So if you're a technical trader and you're just waiting for the 85s, you've missed effectively 70 to 85s, 15 ticks of a move. And if you leveraged up, 10 lots, 20 lots, 100 lots, 1,000 lots, you can start counting your own numbers and working out, what you're missing out because of almost the static, non-linear, undynamic nature of just purely trading, off the chart levels. Whereas when you're seeing that change in the auction activity, when that stone is being dropped into the price ladder, you really can start seeing the market awaken from the abyss as it moves to new frontiers and new price discovery zones. So that's what's really important. And the more velocity and energy going through the market, and when I say energy, the more orders being transacted, the more you can actually start designing your trading strategies, because you can start seeing the underlying buying and selling activity. Okay, next slide. This is quite a novel experience. I'm always used to speaking to our traders on the trading, on the training floor or in our training room, and I can always see the visual cues of eyes. And if I see a couple of traders falling asleep in front of me, or a couple of trainees, then I know I've got to maybe pick up the tone. If no one's understanding me and they're all giving me awkward faces, so it's a little bit of a challenge. Hopefully all of you are not being completely lost. So I hope the questions at the end, I can, if any of you are confused, hopefully I can answer those in a little bit more detail, or maybe paint a clearer picture. Okay, now how market velocity defines the type of auctioning environment. So as we mentioned in the previous slide, the greater the level of order intent, the easier to see the true nature of the market. Okay, now you can, as you embark, if you are already a price ladder trader, or if you're embarking your career trading on the DOM and having direct market access to the exchanges, which is one of the most critical things with regards to making, counting your numbers by the end of the year, as opposed to being a spread. And this is the great when you have direct market access, is as you develop and as you journalize your experience, as you have a very concrete ability, a learning framework, you'll start defining your own types of environments, and each type of environment will require a different type of deployment of a different type of price ladder trading strategy. So if you have how I would define a lethargic market is when the orders going through the order book are 20 lots every say 10 seconds, and there's nothing going through the market. And a lot of times that is just, it can be dominated just by market makers, people just passively waiting on the bid and the sell, hardly ever, any orders going through. So therefore, you're not going to be engaging when the market is in, in its lethargic nature, and a lethargy being defined by, a low degree of lots or lots per second going through the market, depending on what market you trade and how you define what is high and what is low. And that's a process of observation and consistently watching your market. Then you're not going to deploy a very hardcore momentum breakout trade. And those days can, they can, sometimes these lethargic days can just be liquidity operations where the market is just jumping around, but slowly finds a little pain point for people who are participating, picks up some liquidity before it rotates towards the other side. Then you get your so-called stop-start days, where the market looks like it's about to break out, or it's broken a new high, it's made a new high, and all of a sudden the velocity was really good. You get it on the, stay on the buy side, if it's breached towards the upside, and then all of a sudden it just dies down very quickly again. Market rolls over, it picks up again, and those days are sometimes potentially the trickiest of days, the stop-start days. You have a mixture of participants, you have your locals, you have your algorithms, you have your market makers. You don't really have your large institutional time frame players. You might have one, but you might not have as many orders, to get away in the market that he's trying to upload his orders. But those stop-start days can be tricky days, whereas the lethargic days, well, if you can, it's fairly easy to observe them once you gain experience, and it's even easier to sit in your hands, whereas a stop-start day that's at the extremes, you need to have the ability to identify what a stop-start day is very quickly. When it keeps on breaching, twice or three times a new high, and then it rolls over every time, it's just making sure that you're not going to be caught up in this this level of Einstein insanity of repeating the same mistake multiple times, and getting involved. And every time you see a new high, you buy it, and then it rolls over 4 ticks. Every time it makes a new high, rolls over a couple of ticks. And those stop-start days are sometimes, for younger traders, the days where you actually see the greatest P&L loss. Then there's the high octane days, where the market starts breaching, or you start seeing the velocity levels picking up. You start seeing the volume levels picking up. You start seeing the activity in the auctioning picking up, and all of a sudden you can be more aggressive at the extremes, at a new low or a new high, because it's consistent auctioning, it's consistent activity. But what the most difficult part of that is, if you've had a lethargic day for 4 days in a row, or a stop-start day for 4 days in a row, and all of a sudden on the 5th day you have a high octane day or an aggressive day, is just being aware of the mental inertia of carrying through your experience of 3 previous days, or say buying higher or selling lower, and always paying down a couple of ticks, and therefore having that scar tissue of the previous days. And instead of looking back on the previous days, is having that objective approach where you're actually acting on a pure objective analysis of the order velocity and the auctioning speed going through that. If you can see a concrete change in the transactional speed of the market at these at new levels, then it's the ability to shift gears, have that understanding that the true nature and intent of the orders going through the order book have changed, and therefore be able to execute your more types of your arsenal of momentum type strategy that you might have at your disposal. And really, and I'm just giving just a few the types of environments. You can define them in periods of the day, pre-cash session, post-cash session, with regards to the market midday ranges, lunchtime ranges, US Open during the US Open session or the European session. So these are you can have multiple subcomponents of these types of environments. I'm just giving you some of my own ones of how I've defined it, how it makes sense to me. And every one of you, as you gain your own experience, you'll start developing your own techniques of identifying what type of environments that you understand. So then you get your so-called shape-shifting states, where you get all seasonal participants. The market breaks up in the morning, aggressively. It's a high octane, market. Then it finds a range. Then it becomes rather lethargic, for the next 4 hours. Then it makes perhaps a new high, rolls back for the next hour, so stop start, and then all of a sudden it's consolidated for good 6 hours. In the late afternoon, after the morning move, it finds another momentum move. So during the day, you might have to deploy multiple price ladder strategies, depending on how the market shifts through various phases within a day. And not only within a day, they're within a week, within a season. And at the moment, in this cyclical period of this year, we've really, in the markets, within the equity markets, within the bond markets, we've had little spurts of volatility, but the cyclical nature is really low auction activity, where extremes are being absorbed, where the market approaches a new area where you'll see perhaps high volume activity, but there's just someone sitting on the other side. And therefore, to be able to observe that, and the moment that auction activity starts slowing down on the buy side, and it's been spending 10-15 minutes over there, then the moment it starts tickling back down and the auction activity picks up again, and then just trades back into the range. So the cyclical nature of the order flow volume environment for the last 6 months has not been, it's been more your stop-start type of sessions, mixed in with a bit of lethargic nature and the occasional high octane day. When I say occasional, I mean occasional at this moment. So therefore, you're having a lot of trading price ladder strategies that are very effective with certain type of scalping tactics, intra-range, looking for various types of price ladder patterns of a couple of ticks. And those momentum type price ladder volume breaks aren't the ones that are paying are paying your P&L at the end of the day. So really important. The moment you can identify your environment, it helps with your ability to deploy the right trading strategy. Okay, so let's go on to the next slide. I hope everyone's still in there and still doing well. Okay, so let's just, I've already covered a lot of these things, just through my rumblings, but let's just go over it again. So the importance of market velocity. It helps determine the nature of congestion or trend characteristics of the market. You know, a market when it's in a congested state, whether it's in a weekly congestion, a daily congestion, an hourly congestion, generally that's dominated by low auctioning activity, low volume activity, and really that defines, you know, the nature of a congestion. So just as, you know, as I'm talking about, what I'm actually doing, and this is I've kind of decided, you know, on, you know, during this webinar, is if you've been watching this market trade, you know, if some of you have been glancing, you know, at this ladder, this is now, we're approaching UK time, you know, 126. And you've been watching the auction activity, you know, the lots that are going through the market. You know, it's 120 that's just gone through, and we haven't traded now for the last 5, 3, 6, 7 seconds. 50 lots have just gone through, 180. And I just want you to understand that relative speed. And when we start trading up here, we want to see if we see that difference a little bit later on. That will be literally in about 9 minutes time. So just keep an eye on how this market is trading before we trade towards, you know, the other extreme of this, you know, this volume value area. Okay, so it also helps determine the potential market participants and strategies being executed. And as we mentioned before, you know, when the market is fairly lethargic, it's normally dominated by your algorithms. Normally prices aren't really real. You might get a couple of large orders, but these large orders get pulled. They don't get traded, both on the offer and on, you know, on the bid. You know, it looks potentially aggressive by the size of the orders, but nothing's being traded through. And those are generally, you know, your liquidity operating, you know, algorithms that are seeking liquidity, and potentially, you know, the market gets dragged one way and the other way. But you know, just really understand it helps identify the potential market participants and the strategies being executed. Whereas when you see large orders at the extreme, or large orders approaching the extreme, and the large orders are being traded out and they're being auctioned, and buyers and sellers want to engage, and there's a lot of volume, a lot of activity, well then you know your so-called momentum, you know, your technical momentum strategies, whether they're automated or discretionary, are being executed. There's a lot of hive of activity. There's a lot of interest for the market to continue auctioning higher, because it's finding a level of strong intent and a level of strong interest. And it helps the ability to determine if the market is ideal for certain types of price ladder patterns. And really just, you know, almost summarizing, you know, what we said below. And we actually, you know, in one of our order flow training courses that we offer at Axia, you know, we look at a whole myriad of different types of order flow patterns and strategies around the various types of you know, environments. And you know, your key high-level ones are, you know, your type of absorption type patterns, your flipping type patterns, and your momentum type patterns. And absorption type patterns, just, you know, quickly described, is anything, you know, it's a very you know, high level. The various you know, sub absorption patterns. You know, it's just a high level description of a certain reload, but what that reload, it looks like when it's more, you know, a stronger reload pattern than a weaker reload pattern, and the same for the flipping and momentum. But for an absorption type pattern, it's, for example, at 62s, if every time someone sells, you know, into 62s, and you know, the market goes down to one lot, and then they put another 100 lot again, and then they sell back into it, and they keep on reloading this price. That's, you know, either called a reload or someone absorption or sitting on the bid. There's a whole bunch of different trading lingo that you can use for types of absorption patterns. At the moment, there is actually a little bit of absorption going on. I mean, you know, a very tiny bit, but someone is, you know, just sitting on the bid at the moment every time they do offer it down. And then flipping type of one. Now, there's a whole, so many different types activity that you can get in the, you know, get in the market, and there's so many different types of flipping strategies that you can execute, and always the seasonal change of these always change a lot. And what I mean by that is effectively when orders are being pulled, you know, either on the, you know, sell side or the buy side, and the market just gets you know, hunting you know, at a price area where it gets its liquidity. So all of a sudden the market might trade up 6 ticks. Whereas, say there's a 79 lot, as you can see, 120, 178, 58, 89, the market trades up, but it only traded 20 lots. So it went from 66 to 70. So effectively, all of these orders weren't really real, and the market trades up towards the 70s, but everything gets everything gets pulled, and then all of a sudden there's a bit of a liquidity hunting operation, and then the market potentially moves rotates back down again. But again, there's a whole universe of strategies which isn't the objectives of this talk, but it's all through practice, diligent and conscious practice, that you can develop these order flow price ladder skills when you identify the velocity and auctioning environment that you located in. And then we have your type of so-called momentum plays, and your momentum plays are really rather those used to be great plays, financial crisis times, 2007, 8, 9, 11, during the 2011 European crisis, when news and trade in the market trading new highs or new lows. Momentum trades were the trader of the day, being aggressive, being extreme, when the order velocity was consistently high every single day. If you then continued with this type of strategy, when the order flow environment changed in 2012 in the bond universe, all of a sudden that momentum type play in a market that lost its activity level, lost the exchange, where all of a sudden the participants were almost exhausted, I would say, from after almost 5 years of fairly intense volatility, or momentum plays stopped being the sweet of the day, or the fashion of the day, and therefore it's having the ability to maneuver between your different type of price ladder strategies. Okay, now as you can see, we're slowly starting to approach the 70. You can see we just came down now towards 62s, but we came down hardly on anything. Well, this was, I think, what time was this now? This is at 13:32. This was the last little spike that we had down, and you can see it. 60 lots, 70 lot, 20 lot, 100 lot. Now I really want you to observe this: 10 lots, 70 lots. So not much is moving the market, quite a few ticks. Okay, so I want you to really observe that. So it's hardly anything that's moving the market. There's moving 20 lots. The market is a little bit brittle. There's not much on the bid or the offer. It's thinned out. This is because ECB's Draghi is speaking, but you still want to be observing what's the nature of the order flow activity. So we came below this range, but we hardly traded, and we've come back into this area now. So we're seeing 50 lots moving the market, 5 or 6 ticks. So there's low liquidity on the bid and the sell. There's not much auctioning activity. There's a bit of speed going through, and there's not much size being transacted at every price. So this is why the market hasn't been able to really hold the sell on the sell side. So we are watching this closely now. And let me go to the next slide as we practically watching this. This market as it approaches this area that that I was keeping an eye on all during the press conference this afternoon, is because I know it hadn't visited there a lot, but what I wanted to see, one of my strategies for this play was there going to be a relative pickup in volume going through the market, auctioning activity, and speed going through the market, and the size going through the market relative to the other side that the market was trying to auction. Okay, let's go to the next slide. Okay, I've just lost my ladder there, so let's just pull it up again. Okay. So how market velocity can help structure your trades. Now, what's really critically important is, and I'm going to try and, I have a few more slides, so I'm going to go a little bit quicker now because I don't think I have much time. I have about 70 minutes, and we want to get to those Q&A as we want to get to the Q&A session. So I'm just going to go through this a little bit quicker. How market velocity can help structure your trades. It really helps reconciling the technical landscape, the level of market velocity, and thus the conviction of your trade. And what I mean by that, you might have a 5-minute now level over here that you've identified at the 72s, and I'm going to keep on ramming the same point home, but you have now a level over here. And if you have just a technical level, and all of a sudden the market starts approaching this level, or you have a technical level at the highs of the day, the 85s, and you're just executing on the chart, you might just buy one certain size. Now, what separates the greatest of traders, and our top traders at Axia Futures, what really makes them is their ability to shift from a very small clip, say 2, 5 lot, and move into 100, 200, 300, 400 lot in the moment they see that shift in the personality of the market, and that's what really helps. Where you can't do that, it becomes more challenging on a chart when you can't see the level of intent and the level of interest when the auctioning environment, because the moment that auctioning environment changes and becomes, certainly when it becomes, as obvious from your observation points, is the moment that picks up and that activity picks up, it's the ability to get in, really, really aggressively leverage up, because you're being protected by the volume and the auction activity of the market, which you cannot see on the chart in that real time as the market starts printing per time frame. But when you're seeing it on the ladder, you're seeing the activity picking. You start seeing the activity picking up, and that's when it's really starts becoming important. Now, what I want you just to observe here quickly is the size of these offers at the moment. Between 90 to on the large scale 400 lots. And over here on the buy side, between 100, to the extreme of 300 lot, and what's still going through the market is between 20 to between 20 to 30 lots, that are going through the market at the moment. So still quite a low level of velocity, but we are starting to approach this area over here. Now, understanding the velocity landscape to determine the level of engagement. So again, I've repeated that. So the velocity landscape. So when if at certain regions the orders that are going through are have been slow. So all week, every time the market approaches the 85s, it's you're only seeing about 100, 200 lots trade through, or the market or the prices start flipping. So there's not really much activity. There's no really bids that are holding up. But the moment you start seeing the velocity area change, and it completely alters the last time it visited this zone, then your price memory, if you can recall, because you've taken your notes, you've taken your conscious notes, then all of a sudden you can start acting with greater conviction, because the velocity landscape in this price zone has completely changed. Okay, so the market is starting to breach up a little high. So you're watching 200 lots starting to go through here, okay, at the moment. So there's about 8,500 lots, so as opposed to the 50 and 20 lots that were going down here, still the same difference. So they're still sporadic, these 100 and 200 lots, and it's gone down to 30 lots. But once we start seeing more consistency in the size being traded through on the bid and the offer, then all of a sudden you can start being a little bit more intense on the buy. So you can start seeing the 100, 400 lots, 500. We had 100 lots over here. So the market is all of a sudden starting to wake up its activity over here. And when I say wake up activity, not by the bids and sales, but what's going through now. So you're starting to see, a lot more 100 lots going through. We hardly had any 100 lots going through over here. So you're starting to see the activity. So if you effectively, putting some buy side trades over here, and you're entering the market, in this region, you're now starting to say, well, I'm being protected by the level of intent and the level of the auctioning activity in the market. I mean, you see 500 lots being exchanged there, 600 lots, almost 200 lots. You can see it's substantially different now at the moment as you enter, on the buy side. So really, really, a change in the nature of the velocity, the change in the auction activity, the bids. Now, the offers and the bids have started chunking up. You can see a 600 lot that got taken. You can see all of a sudden the market has woken up. It's moving to its so-called more high-octane environment from its lethargic nature. So this is really rather critical. You're observing this change. Now in this instance, once you started noticing that, you potentially got a long, between the 72s to the 75 area, and now you're looking for the market. Now what you don't want to start here. You want the market to continue its exchange. But you can see all of a sudden the people who want iPads, everyone's putting their hands up now. We're now in new price discovery zone. There's a lot more auctioning activity. You can see what's going through here, 165, 200 lots. So the relative difference, what we were speaking earlier on, where we're only having 50 lots, 10 lots, 20 lots going down here, it's all changed up here. And this is the big difference. And this is where, if you have price memory on your price ladder, you really start understanding it. Almost sound like a horse commentator, describing, the relative speed. But it's really this is so critically important. It's what we really drill into our young trainees and our young traders on our training floor is really being able to be so cognizant, so aware, so alert, so focused, so in the zone to be able to know when that market shifts its gears, you have the ability to shift your gears, and you have the ability not only to shift your gears but to get size in the market when it counts. And this is the difference between someone who's your typical daily trader who isn't a high performance athlete in the financial markets, as opposed to someone who knows how to really step on the gas when the market is showing you it's time to step on the gas. And it can just take a very brief moment and a brief opportunity. And you can see over here the market is all of a sudden this area is being highly protected. There's a lot of trade going through here, the 78. Before this I think there was about 4,000 lots over here, but it's still being protected, still being auctioned. It's slowed down a little bit, but there's still certainly someone protecting this little zone here between 77 to 80. And this is such a great replay to watch on how to develop your central bank order flow skills as well. Okay, before I get too excited, let's move on to the next slide. Okay, and thank goodness I've been talking about this this whole time. So I actually jumped into this example, really from the start of the webinar, and I was only going to jump into it over now. So I think that actually worked quite well. So this is the example of the European Central Bank today's meeting on the velocity, and I call it the velocity development mid-range. And when I say, this is the high of the day over here at 85s. This is the low of the day at 50 that you can see. And all of a sudden, where you won't be able to see that on your technical if you just trade it on chart, all of a sudden you saw the velocity development shift from 20 lots a second all of a sudden to 100, 200, 300 lots a second. And the market, I remember this, the market came back one more time just to test this 73s over here, just to see if there was going to be any more people who wanted to step in on the sell side. And after it came back to test here, it then went higher. And actually, if you look at this replay a little bit later on, the velocity started increasing even more once it breached the 83s. And this continued all the way up to, I stand to be corrected, about 25 or 30, on the day. I actually just, I had to leave the trading floor at that time. But, after it tested and it started breaching towards 83s, 84s, the velocity intensity started picking up a more, a lot more intensity, and you could start, and then you could start attacking, higher prices again and be more active. And when you notice that first velocity, pick up, or the intensity of the orders going through, and you went long, you could, go long with a core position and potentially scalp out at somewhat. You started noticing it started slowing down, a little bit, while still holding core position if you thought the market, would start breaching higher, because you really did like the activity that went through at the 73s and 72s. So really worth going back and looking how this market, shifts and moves towards the upside. I will briefly, very brief, because I think I'm running out of time here. Just combining market profile and order flow. One of the tools that we use and we've been using for, the whole screen part, screen-based or proprietary trading, when it went to the screen market. When I started my career back in, in London, almost 13 years ago, this is the first, charting tool I was introduced to, and it's what we all use in our trading ports. And we really combine our order flow with our market profile, tool, and you can see the market now, starting to move up towards higher ground. And what I really like, what you have here is what we call a big ledge pattern. And what I really like to do is when the market breaches, this is the next trading session, this is the profile that is split, so effectively half-an-hour patterns. So I'm not going to explain too much what a market profile is now, so I'm sorry to those who haven't seen this before, but just look at this as a level over here. And when you have a very big anomaly ledge level and the market breaches it by, what we call a substantial amount, and there's, 5 TPOs, what each letter is called is a TPO, and you have 5 TPOs and the market breaches lower, and it breaches lower by 3 times the count of the TPO. So in this instance, by 15 ticks, and the market comes back to test this level. When I'm going to have conviction on the sell side is when a market approaches this level on a retracement. If the volume and the activity picked up all of a sudden, Okay, so if all of a sudden, say there was good volume on the down move, and then when it came back up again, and the volume and velocity intensity picked up even more than down here, I would be careful of selling this level back down. What I want to see is if it retraces back and all of a sudden the market starts, not auctioning anymore, starts flipping around, stop showing a lot of well transacted orders or orders going through the market, and the velocity not really going through the market intensely, then all of a sudden I'm going to start building a short position, because I'm now seeing the volatility and the velocity environment that I like for a retracement trade towards a key level that I like. So that's the kind of conditions that I'm looking for on the price ladder. Now you can see the activity still going, 150 lots, 200 lots. Look how different that is, 300 lots compared to it was when it's down here. And that's when I talk about understanding your relative range difference on your order flow price activity. So this was just a quick little strategy that that I trade and play when I've taken a key ledge break and the market rotates back. If the volume and velocity level starts picking up, I'm not going to try and pick a short sell retracement, even though classic technical analysis says, well, this was a former technical, this was former support, now it's breached, should turn into resistance. It only becomes resistance when I see a certain type of order flow activity and more type of flipping type of action in this zone, and that's when it's really, really key for me. Okay, this is just a market velocity matrix that that we use amongst the traders. Just something that I've created, for your various types of price ladder patterns. Your momentum, your absorption, your flippers, your large order, your reversal zones, and it's really nice. The brain always works really well when you start creating a templated matrix. And when you have that templated matrix in your head, you can effectively really start designing. That you really start putting your brain in certain compartments where you can start putting in various locations in your matrix, your internal conscious matrix of different types of price ladder patterns. And what I like to see, as one example, we'll just look at here on the price. So for momentum plays, I like to see high velocity, high auction activity, high volume, and the market vicinity, it needs to be near the highs or the lows. And for example, when the market for type of absorption, to see the absorption really clearly, I also want high level, high auction activity, high volume level. Market vicinity is not important. And this is really, when we look at the optimal environment for the price ladder pattern. It's just a high level summary of price ladder patterns, optimal environment conditions. And exactly, it's like a plant, like a plant that you're watering, or it's in a certain plants breed better, or not breed, but grow better in certain environments. You can't go to the Costa Rican rainforest or the Brazilian Atlantic rainforest or the Amazon and grow those succulent desert plants, and vice versa. Certain plants, and it's the same thing in trading the price ladder as in sport. If you're a great cricketer, if you're great, it's your ability to work out in environment. If you go play on a bouncy cricket pitch in Australia and South Africa, you're going to be really playing, potentially more of your back foot. You're more of a back foot player. If you're playing the subcontinent, when the ball is spinning a little bit more, you're be working your wrist. So different environments require different types of training strategies. Same if you're a Formula One driver, you're going to drive with different approach on a wet track as opposed to a dry, fast track. And this is really critically important, is you deploy different strategies given a different market velocity or order flow environment. So again, this is just a matrix. Have a look, but this can really go into quite a level of subtle detail depending on what you what you're looking at. This is just a high level approach. I'm not going to. I'm going to spend 30 seconds of this. This is just an example of some of our traders who have developed their own individual unique order flow style, and it's really understanding your game. As you develop, as you have a really good learning technique and skill, you really develop really well what's good for you. For example, Demetrius is incredible when the order flow activity and the risk-off theme environment really changes intensely, and that's the type of order flow environment he wants to see. You know, Sven loves seeing when the market slows down, you know, when the algorithms start, you know, dominating, and he likes to do, you know, rapid, high frequency scalping trading. Simon is another type of momentum mid-range trader to, you know, extremes using the profile and the order flow. Then you have Gabriel, who loves your certain types of, you know, he's evolved from a observing large orders on the order book, seeing certain type of price actions from algorithms, to being a great momentum commodities breakout trader, but shifting his momentum type of strategies around what the order book is doing. If he's trading an outright, big momentum commodities trade midnight, or, you know, in the early hours of the morning, he's going to have a very different approach to that, because the volume environment is very different compared to doing USA cash session. And the same is true, you know, with Brannigan. Probably a lot of you out there know Brannigan. He loves certain types of currency plays when the market, you know, when certain stops getting triggered, and what he's looking for on the ladder. And Alessandro Bonafini, a really great gold and oil swing trade. He's always looking for certain types of slowdown of auction activity when the market has lost its momentum in one direction. Okay, and just wanted to end off there. I've literally hit the hour mark. The most important thing is, what's your skill-based protocol? And the most important is your power of conscious observation. You know, every day, don't just sit there and not have a conscious, you know, in the beginning when you're just watching the ladder, you're probably not going to understand anything. But the brain is phenomenal at, you know, the ability to put the puzzle together over a period of time. As long as you observe something and you ask yourself the questions, and you have a really concrete framework of learning, or a methodology. And sometimes to develop that methodology, it's great to learn from someone, or it's great to learn from a great mentor who is a great, price ladder trader, or, you know, or a firm who does specialize, you know, in that space. So it's really important. Does your skill, you know, always ask yourself, does your skill-based development protocol allow for developing different strategies? You know, what is your methodology to learn these skills, or to pick up various types of price ladder skills? Does your learning environment activate all your senses of learning? You know, sometimes that's why you have traders that are either within a very good, if you're in if you aren't blessed of being on a training for the beginning of a career, then just make sure you're in the right community where you can enhance your your learning. You're activating all your senses. You know, a human being learns through the activation of multiple senses, and that's why a lot of times young traders develop a lot better when they're in a group of experienced, successful traders. And how professional is your approach, and who do you benchmark your performance against? Elite order flow traders. And just remember, cognition, evolving with your environment. You know, your symbiosis of learning development doesn't mean if your methodology of learning is one way, 1 week. You're always constantly evolving and changing, making sure you have the methodology to learn the skills. Are you asking yourself, at the end of the day, you potentially tried a momentum type strategy. You observed certain types of order flow or orders transacted on the ladder. But then at the end of the day, you actually lost money on something that you thought you identified. Well, then you have to go back and see where you lost money, why you did it, what were you observing on the order flow, what was your self-talk during that trade, and then rectifying it. But don't just go home and say, oh, I lost money today, and not pick it up, because what happens is that loss will hunt you down again if you don't rectify it and see why you lost. Was it because maybe the market was actually flipping more than the orders were being transacted at that extreme? And just remember, skills breeds confidence. Confidence does not breed skills. A lot of people say, oh, I have a great psychology, and all those books out there on psychology, and which is paramount and important. But if you don't have a great skills protocol of development, it doesn't matter how much confidence you have, you're not going to be a great trader. You have to have a great skills protocol to develop your price ladder, to develop your strategy, whether it's price ladder or however other way you transact with the market or you trade with the market. If you have a great skills protocol, you're going to develop the confidence, and it's not really the other way around. You can't just come to the market and say, oh, I feel so mentally strong, I'm tough, I'm strong. But if you don't know how to put a trade strategy when you see something, it doesn't matter how confident you are, you're going to consistently lose money. Okay, well, really, that's that's me. I want to thank all of you who sat through this entire hour. I run our London training for for Axia Futures, and we have a wonderful team there. So if we have some great learning resources. Go to our YouTube channel. There's a lot of stuff. We also do some live trading once a week, or our Instagram Axia Futures, and also also wanted to say with regards to the Jigsaw platform, we're actually using it a lot for our replay training skills, and it's really a great platform. So I really recommend those who are trying to develop their skill. And just want to thank everyone for your time. Otherwise, visit us on our website, axiafutures.com. And thank you for listening, guys.
Okay. If you have any questions, please type them into the questions box, and I will start trying to go through it and ask them to Alex. All right, let's see. What is the easiest way to visually decipher absorption versus consumption of liquidity?
Okay. That, with regards to that, depending on what market you're trading, and that's, again, a lot of that becomes when your skill set, and a lot of times I believe in your intuitive skill set through the powers, and we're talking about earlier on, the powers of observation, is sometimes you don't know if someone is absorbing it, or as the person asked the question, consuming the liquidity. But that's when you start using your ability to shift your conviction levels with the size that you're putting. So for example, if the market is trading say at 94s, and someone keeps on selling into 94s, and they're bidding it up and they're holding it, and then eventually he's observing a reloader, and then eventually he loses the battle and the market trades the other side. But with regards to that skill, it's individual to each person. I could go to our entire trading floor, and there are moments on the trading floor when we're saying there's a buyer over here, and you can see it's completely you can observe it very clearly. And the clearest skill that I personally use is the nature of the order going through. So for example, at 164.95, okay, there's a 500 lot over here. If originally the pace that the market was selling into the 95s was, and I'm just picking a number, was 200 lots per second, and it keeps on reloading the 95s. Then all of a sudden it shifts down to 100 lots per second. And when you start noticing the sell side activity starting to slow down, and the speed of the transactions hitting into heading into the bid, and the bid is still reloading, then your conviction levels start rising. So for me personally, what I look for first is it could be very aggressive in the beginning, and you don't know if you can notice that there's a potential iceberg or a reloader or someone absorbing the pattern. But what happens is the moment the transactions speed starts slowing down, well, then you start saying, well, the buyer is potentially winning this battle.
Okay. Let's see. There's a long list. I'm trying to work my way through the questions.
I see a question. Is this Alex's account number showing on the DOM? No, actually, this is our replay. This is a replay platform.
Okay, Peter Davies mentions iceberg orders often. Can you dive into that topic? Are iceberg stop action where absorption is occurring?
So just say that last word, where stop. Sorry, I didn't hear that last bit.
Are iceberg stop action where absorption is occurring?
Iceberg stop action. Okay. I think I understand. Well, I hope I understand the context of the question.
Assuming stop
So,
orders.
so when the stop orders are triggered, and then there's an iceberg. Let me assume that there's. Oh, I can give you a couple of scenarios. So, for example, sometimes, I mean, you know, the landscape of new synthetic type of orders, the entire of the last 2-3 years, you have so many new types of synthetic orders, new types of time sliced orders, volume slice orders, different types of iceberg. You know, an iceberg can exist within a certain price zone at one specific price, and we've seen the nature of where fundamental events, where a market stops higher or lower, or gaps higher on a fundamental Sunday night event, and on the Monday morning, all of a sudden the market is opening up, and in the past it would stop up 50, 20, 60 ticks, whereas now it actually reverses the other way without even triggering stops. And on the back of that, even you get these iceberg orders on the open, where the market opens and there's someone just keeps on reloading, potentially 5 to 3 ticks, and that iceberg could either be programmed for every 100 lots that goes into the market, it reloads itself, or for every 2 seconds that 100 lots goes through, it reloads itself. And that can happen on the back of on the back a lot of stop orders that go through the market. So I might not have answered Peter's question there if I didn't understand it for you what the question was, but I hope I gave something else.
Okay, let's see. Do you even let your traders look at charts before they've mastered the ladder?
No, we do it the other way around. We feel that charts can create many biases, and so we actually, for all of our young guys, we actually don't give them charts in the beginning at all, and it's just purely the price ladder. We feel we have some traders who don't look at charts at all. We actually have some traders, and one phenomenal trader who actually doesn't even have price. So all he just has the sell side and the buy side. So he just has the sell orders and the buy side of the market, and he actually does not have this middle column here. So he doesn't have a price at all. And so that's one extreme value, and all he's looking at is certain types of order flow patterns, and that's how he trades and executes. But with regards to if you had once you start gaining greater price memory, and your price memory expands, the more time you devote to the price ladder. And when you watch the market, you can watch the market the entire day without looking at the chart, and you can actually map the chart in your head. And what's even more effective with that than when you map the chart in your head is you're also mapping where the order flow areas, or the buy or sell zones, or the various types of orders that were transacted, where they occurred at what prices. So you have a more in-depth understanding of that level. You have a second, third dimension of that level, as opposed to if you just look at a chart, you don't know how orders were being transacted at that level. So that's So for us, it's all ladder in the beginning, and then we start. Then the next phase, we start slipping in the market profile.
Okay. Let's see. Can you give a brief explanation of flipping?
Yeah, bar not giving too much away in the public domain, but this is a sharing space. But effectively, what that is when, for example, and we actually have we have some examples in our order flow training program. There is a free element inside there. But what essentially it is, just a high-level summary is, say, for example, you're looking at the 05s over here, and you see 400 lots, 100 lots, 258, 500 lots. Essentially is when the market has these orders, and the market then trades your 05, say 100 lots goes through, and then all of a sudden the offers just start putting these orders, and the next thing the price is trading 09s. None of these prices were really traded. Gets to 09s. All of a sudden, anyone who was potentially short over here because they saw a bit of size, and the market starts getting, the market, all the short sellers start liquidating this position. But then someone is sitting there on the offer, takes it on that side, keeps the buy side fairly chunky and thick, and then pulls it back the other way. So effectively, the market can pull one way and then the other way, with the orders not really being a true representative of actually what's being traded through the market.
Okay. Let's see. In your matrix for reversal zones, how come velocity level is low?
Okay, so let me just get it back to that slide quickly. So a lot of the time, and we're talking about that example earlier on about the Apple iPad version 20, and when the market can have extremes, either where there's a stop hunt, and that's the final hurrah, the so-called volume crescendo, and then all of a sudden it stop hunts, but then the market retraces back very quickly because there was not much activity. Now a market, when I say to you again, how many people want an iPad for $1? Everyone's going to be, putting their hand up until I get, say $50, $100. And then all of a sudden, when I start getting to, $600, $800, and all of a sudden, I'm going to have less people putting up their hands. And it's the same thing with the market. If the market reaches a certain area where there are not many participants want to engage at this new price, all of a sudden you'll see the transactional nature of the speed where people, buyers and sellers, aren't wanting to accept at these new levels. So a lot of times reversal zones are defined either by that volume crescendo, but that volume crescendo is actually can be met by it can be met by some high intensity and and velocity. But when the market starts reaching extreme, and all of a sudden the transactional nature starts slowing down, and the market starts turning back down to auction and find new participants engaging at a better price, where people want to engage in an exchange. So a lot of times, the best reversal zones are the ones where the market has reached an extreme, and then all of a sudden the auction activity starts slowing down relative to where it was on the other side. But I'm not precluding the fact when it starts becoming a definition challenge when you have a market that blips up or triggers some stops, and when it triggers those stops, you do see a lot of activity and volume. But at that area that there's a lot of activity and volume, where there could be an iceberg order, or or some sell side algorithm, but the order is just above that, there's a whole low volume node where no one transacted at that area. So a lot of times, the extremes on a crescendo move, hardly anything got transacted. And you'll see there's going to be a 300 lot, and you can see why. I mean, if you look at here, most of the chunks of the orders are being done over here. I know we're trending now and making new moves, but we've moved away from here because maybe the market stopped, it started slowing down. So if you started noticing over here, the market probably would start slowing down, and that's on the reversal zones, is when the market no longer wants to transact in that territory.
Awesome, thank you. Are different entry order types, market versus limit, appropriate for different patterns, i.e. are market orders most often used for momentum plays, where limit orders are for reversals?
Another thing, I mean, with regards to us in the proprietary trading industry, we actually we're a discretionary based firm. We have a few system traders, but as discretionary traders and trading our our younger traders on the price ladder and looking at various order flow patterns, we don't use many order types. We use them a few for our momentum breakout in certain less liquid markets. But in the day range, we rarely have, unless we get away from our desk and we think the market's going to move another 30 or 40 ticks. But whenever we're in the market and we're sitting at our desk, we generally go in and we strike at market, or we get out of market. But if we're looking for example, if I buy, so say if I get out and say I sell over here and I'm short now 165 double O's, and then the market keeps on trading higher, and it comes back, I might queue to get out of my order. But that's almost as sophisticated as we are with regards to a discretionary proprietary trading house, and potentially the odd market order or limit order for potential breaks of markets. We generally hit at markets, or we might queue if we're going offside on a trade and waiting to get filled, or we just strike out of market. We don't really use many sophisticated order types.
Okay. Psychologically speaking, is this style of trading better suited for younger brains and more responsive nervous systems? In other words, can older traders learn and perform competitively with younger traders?
Yeah, that's a really good question. It has been maybe the thought process or the mind state, or the prevailing wisdom that when you're a young 22-year-old or 23-year-old out of university, and then as a prop trader, those are your years where you're developing your cognitive abilities to pick up patterns are extremely well. But I'm seeing the same transition in intraday proprietary price ladder trading happening as you're seeing in the tennis world, where you're seeing guys who are occupying the top 5 positions or top 4 positions, all in excess of 30 years old. And whereas it was just a young man's game, you're considered old after 27 and 28. So with regards to price ladder and being responsive, I think the most important part is developing having a concrete skill-based methodology to develop your skills, to understand what type of strategy you want to employ that works for your unique personality profile, and that's regardless of age. Because I see some of our older guys, when I say older guys, okay, I'm talking about guys, say they started with 22, 23, and now they're about 38, 39, 40. They've changed and evolved so much. But I know a guy who started at the age of, within our team, started at the age of 34, and he's just become bigger and bigger and bigger, and he's now about 40, 42 years old now, and he's completely his price ladder patterns completely evolved, completely changed, and his brain is more at sync, knowing what works for him. He doesn't maybe watch as much screen time now, but he's more effective in his screen time. Whereas in the beginning part of his career, he was putting a lot of screen time, whereas now it's less screen time, but he knows when to work the market. It's the same, it's the same, I suppose, as some of those great tennis players, such as a Federer, knowing when to select to play tournaments and when to step up, because he's got experience on his side. So I would tend to think that just pure observations on in the trading proprietary community is that as long as you have a strong methodology to consistently improve, it doesn't matter the age.
Okay. What is the difference between velocity and auction activity?
Okay, that's a good question. It's one I get asked a lot. So velocity. So if we're looking at this, example, this price ladder now at the moment, if you look over here, velocity is the speed of the orders. So the speed of the orders that are going through on a price. So if there's, like I mentioned earlier on, so if at 06, 30 lots have gone through in the last 5 seconds, then it's like 30 lots per per that 5-second period. So that is the velocity of order. So the higher the velocity, the more active the market is. Now, the auction is, you can have high velocity, but the market is just, you'll have, a 500, say a 200 lot go through 06s, buy 06s, and a 200 lot buy 07s, and a 200 lot buy 08s, 200 lot buy 09. So just 200 lots will be going through the market. But what hasn't happened, it hasn't auctioned. So if, for example, the market goes, a 200 lot goes to 06, then a 200 lot on the bid and a 200 lot, so it's still going at the same speed, potentially, but the market is auctioning a price. And then when it goes to the next price, there's 200 lots that goes through 200 lots, so still operating at the same speed, but staying at the same price, and therefore the market is actually auctioning the area. And that's why I was using that one example earlier on. As long as there's good speed and good auctioning, then the market can continue towards the upside, depending on every individual market's profile and characteristic. As long as the market's being auctioning, say, 3,000 lots on, say, the bunds here at a certain velocity and 3,000 lots, the chances of the market revisiting back are lower compared to if a market had the same speed but hardly auctioned any price. So it could go 200 lots, then that market has a greater propensity to come back because these prices have not been auctioned. I hope that made sense. And
okay.
That takes a little bit of time to get used to, yeah.
Yeah. Are the price ladder patterns easier to read on a thicker market as compared to thinner markets like CL or 6C?
At this moment on our trading floor, it's becoming easier to read it on CL as opposed to the S&P 500, the Euro stocks. You have sometimes when you have such chunky markets and such and that's one of the things we're talking about, market velocity and activity of the market. The greater the activity of the market, the easier it is to potentially see where the buyers and the sellers are located. At the moment, we've had a lot more volatility in oil the last month or the last couple of weeks. And sometimes you can see an obvious iceberg or someone sitting on the offer or sitting on the bid. Whereas when you have very algorithmically dominated thick markets such as Eurostoxx at the moment with no volatility, until that volatility awakens, it becomes quite difficult to actually see the underlying intention of the market. So that changes. The seasons change. So it doesn't matter if it's a thinner or a thicker market. The thicker markets you would think are a little bit easier to see, but they're easy to see if there's volatility within that market.
Okay, I'm going to make this the last question, and I'm going to try to reword this a little bit. How does a discretionary trader move beyond scalping and survive? I guess what can a discretionary trader do to survive in a ever competitive market, especially in short-term day trading, competing against algos and computers?
Yeah, that evolutionary process. So if you start, and we have that a lot. We actually have we're in partnership, and we're partnering with a hedge fund for that has quite a bit of capital under management, and we actually shift some of our senior traders. We'll be shifting some of our senior traders onto that book, and it's also the natural evolutionary process is when you watch the market almost from a micro level perspective, and you have that that great learning approach and that great methodology of understanding of how you develop daily. All of our traders on our floor have to at the end of the day execute a debriefing structure, but a debriefing structure that really gives them great information of where they went wrong on the day and where they could have enhanced their skill set. And when you are doing that approach every day, what's actually happening, what you're simulating, is not only developing your micro understanding, because you could be there all day buying the market, and you're buying in there all day, and the market just can't find a bid. You're seeing the correlated markets all moving. You're seeing the other bond markets moving, and you're buying the bonds, and the bonds are just kind of sat in a 5-tick range, and you've actually lost a few ticks. But then all of a sudden, you come in the next day, and the market ramps up, and you're buying the previous day, you've been exhausted mentally, and all of a sudden the market ranks up. Or what your brain has done there is all of a sudden it's taken a snapshot of that experience. And because you've done it from a micro level, then you see what's happened the following day. And if you have a really good learning structure, you actually start seeing how the micro evolves into the macro element, or how you're trading certain type of price ladder patterns that then evolve into some larger type of pattern. So there's sometimes just a natural transition if you deploy a really good learning strategy where you can move. You can actually move, and I see some guys who, on our floor, who are just taking, 1 to 3 ticks for the first 3 years of their career. Now they're taking 30 to 40 ticks, say, once or twice a week, or even up to 80 ticks in a move, because they've seen that whole evolution of themselves and of their own personal technical landscape. So for me, it's not having to make almost the conscious, okay, this is how I'm changing. If you have a really great ability to ask yourself questions at the end of the day, and ask yourself concrete questions of where you went wrong and where your skill set was letting you down, you then have then the brain starts syncing the actual market together from a micro to macro perspective, and then it's about you exposing yourself to potentially new time frame shifts. And that's what we actually do with some of our senior traders who are shifting from more micro scalping into into the broader technicals. And I know some incredible traders who started from a very micro level and now know how to see the market evolve and shift its gear into bigger, larger patterns.
Okay, awesome. Thank you. Thank you for the excellent information and the webinar today, and most importantly, thank you for your time.
Great, thanks so much, and thanks for having me on your webinar. Really appreciate it.
Absolutely, thank you.
Okay.